I'm going to tell you what to do, and then at the end, I'm going to explain to you guys a major thing that is impactful to your developments that could actually kill the financial viability of your asset if you do this one thing. The U.S. American population has a 7 million unit house deficit in the United States right now, 4.3 million of which are in need of being affordable housing. And the biggest depiction and reasoning for that cusp of homes that are needed is because of the lack of construction pre-2022 and the sheer number of families that are coming to the market. It is estimated that over 8 million people are in the housing market seeking residences where they don't live with non-family residents and they can actually live in their own home. But yet there was only 1.4 million homes that were built at the highest point of the housing boom at the end of 2022 post-pandemic. Now, with that said, that competes with the 2007 numbers, and even in 2007, it was at the height, and then there was a deficit because of what happened in 2008, and then the cusp of non-developed homes stayed stagnant for at least 4 years. It slowly climbed from 2008, 9, 10, 11, but it wasn't until 2012 where the normality of home construction actually started to take place again, which in that interim time, there was a lack and a deficit of over 5 million homes that were not built. So with that said, one of the biggest things right now is that there is opportunity in the single family housing sector. And if you can't find inventory, then what do you do to resolve the housing issue and the affordability issue? You build it. You build affordable housing and you build housing in general. Now, I explain to people that a drowning person cannot help another drowning person. And one of the big caveats to this is that when people come in, they start in the industry of residential investing, they sit back and go, I'm going to play it safe, Jerome. And if I play it safe, I'm going to go into one of the smaller homes, test the waters, make sure I feel good. And then if everything works out, I'm going to invest in the market. And I tell people that's stupid. Don't do that. That's the wrong way to invest. And the reason why is because wouldn't you rather position yourself in a market where there's larger profitability? So this way, if the market cusps, you have larger profitability to be compressed so that way you're not sitting on a minimal amount of profitability, then your profits completely 100% compressed out. You make nothing or you lose money on your asset investment. Okay, so let me explain this on what this looks like, and let me talk about how we actually penetrate the affordability component and that lack of inventory that currently exists in the market today. And so when we're looking at this, and I tell you, a drowning person cannot save another drowning person. If you're looking at helping people that need affordable or low-income housing, I don't want to call them drowning people, but you can't help those people. In spite of them drowning or not drowning, it's an analogy that tells you can't help somebody else until you can help yourself, okay? And what I mean by that is there is a reality to our bandwidth of what we can do to help. Like you can open a door for somebody. You could pick something up off the floor if they drop it. You could give them a couch to sleep on at your house or an extra bedroom, but we're not solving the long-term issue, right? So you can help those people interim, but it's still minute in really resolving the overall magnitude of this housing deficit, and really the lack of affordable housing is the main key component, okay? So when I say it, and I say be selfish and take care of yourself first, I'm not saying that if someone needs a place to stay, don't put them on your couch. What I'm saying is we need to fix the macro issue, not the micro issue. One day, one night, 1 week, 1 month, even 1 year is not fixing the big issue, the macro issue. It's fixing it on a micro level. And so if you want to fix this on a macro level, you have to sit back and say, okay, Jerome, where do I start and what do I need to do and how can we really impact this? Because when you solve a massive problem, ladies and gentlemen, there's massive profits to be made on the back end as well. And so when we talk about over 4.5 million houses in deficit, just on the affordability component, just on the lower income component, we have more than 5 years deficit if we did everything absolutely perfect, which we won't. Now, when we take a look at this and I look at it from a macro perspective, I sit back and go, okay, finances. How do I get the vast majority of the general public is interested in real estate, interested in investing in real estate, interested in making profits in real estate to make those profits sooner than later, and what has the largest bandwidth with the lowest risk and the largest profitability. And when I look at it from a perspective of wholesaling, I look at it from a perspective of fix and flips, I look at it from a perspective of just regular long-term burst strategy, buy and hold, or I look at it from a perspective of short-term rentals and Airbnb perspective, and I look at all the profitabilities, all the spreads, all of what's happening in the market, and I look at what has been the most consistent with the largest bandwidth of profitability, it's buying a simple piece of land like the one I sit on and then building a house on it. But it's in a special demographics that doesn't compete for the average median buyer, because where do we go to find people with money so that we can make more money? You don't sell to broke people to make money. You sell to people with affluency, because your money is in their pockets. And the goal is to get your money back from their pockets back into your pockets, because it's no good. It's no good to have your money in somebody else's pockets, is it? And the answer is no. The answer is your money is better placed in your pockets for investment and long-term wealth building strategies to protect you and your family. Now, once we go in and we hit the upper demographics in this current market, guys, we're building houses 1Z, 2Z, 3Z. We're not building hundreds and hundreds of homes. Are we making an impact if hundreds, if not thousands of us are doing this nationwide? The answer is yes, because if I can get each of you guys doing 2 to 4 every single year, and there's 52 states, and we have hundreds of people in each state, let's say we have 1,000 people just doing a handful of homes a year, that's 5,000 homes that we, the Build Wealth and the Jerome Maldonado community, brings to the market. Now we're starting to move mountains, even if it's not in the affordable sector, because now we have 5,000 homes that are being built every single year by our community. That, ladies and gentlemen, will move mountains. Now, once we have a community that has affluency, there's money in the market, and those people have money that can go back into their bank accounts, now we can start making a big press on the affordability component. As I read, Zillow had some of the best information about the affordability component and the lack of housing in the affordability standpoint of everything that's being put out into the market today. And so if there's 8 million homes that Zillow is projecting that need to be in the market, 4.5 million of those of which need to be affordable housing, then ladies and gentlemen, we have some work to do. Because just like the apartment right behind me here, ladies and gentlemen, you can go in and you can build it and you can add an affordability component. And let me tell you a little secret about adding an affordability component to your builds and to be able to add that to your developments and what not to do when you go in and build these, okay? So I'm going to tell you what to do, and then at the end, I'm going to explain to you guys a major thing that is impactful to your developments that could actually kill the financial viability of your asset if you do this one thing. So let's start off with what you should do, and then I'll tell you what not to do at the very end. So what you should do is you should go in and you should attach some sort of affordability component to it. Now, not all municipalities have programs set in place yet, but most municipalities, at least the larger municipalities, are starting to embrace the affordability component, giving developers incentives. And so a lot of times with those affordability components, they either want to do one of about 3 or 4 different things in order to help make those apartments or housing affordable. And so they give these low-income vouchers. Now, the low-income vouchers are always real heavy at the beginning of the year. Right after Christmas, people are moving out, they want their own space, and then all of a sudden when summer hits, the vouchers drop. Less people are looking for places to live this time of year, like in June, July, August, and then in September, all the way to December, the housing vouchers for low-income families picks up again, and then there's the second spur of the market on the second half of the year, just post-summer. But right now, people are on vacation, they're traveling with their families. This is not a big housing time for people to rent or purchase in the market, especially in the affordability component. So those vouchers go dry, or not completely dry, but they slow down. Okay, now, the reason I talk about this is because I want to make sure that we're setting you guys up for success in the affordability component of everything we're doing. With that said, the municipalities, ladies and gentlemen, they'll go in and they'll say, look, if you make the entire development affordable, then we'll give you XYZ, tax abatements, bonds, grant money, bridge loans that have very low bearing interest rates. There's a lot of different things the municipality will do. Now, typically that starts off from an initiative that happens at a federal level, okay? Then the feds sit back and say, we're going to allocate $500 million to every state, or based on the size of your state, maybe $1 billion. So they do the capital outlay allocations. Then the state level goes in and gives it on a municipal level so that there's state-backed funding and bond money and grant money for these affordable component homes. Now, when you do this, guys, one of the most important things that you need to pay attention to is the AMI, the average median income. And in the vast majority of the United States, because of all the money that was printed during the pandemic, the AMI is actually higher sometimes than what the actual base rent amount is that you can actually rent that unit for. So let me give you a perfect example. Kyle and I, my business partner in Phoenix, just tied up a piece of land that we're going to build 10 units of apartments on there. And one of the things that we did this past Tuesday, we actually drove the lot, and it was ugly in an area where there's a school across the street. So with this school is a plus on the upside. Over the side of one side of the mountain is gorgeous homes. Now, the positive attribute is the mountains are actually a gorgeous view. There's actually no homes. But now on two other sides, one side has a school, the other side has the mountains, the other two sides has very lower median home. And so when we looked at rents, this is a permit ready build. And because it's a permit ready build, we didn't want to have to change the designs. And they were designed with 10 3-bedroom units. Big problem is we almost didn't tie it up because those 3-bedroom units could only rent based on pro formas and comps in that area for $1,850 a month. So we can't rent a 3-bedroom apartment for $1,800 a month because we can't make it cash flow. There's not enough on the top end to be able to stabilize the cost of building the asset. So then we looked into low-income housing vouchers. And when we looked into low-income housing vouchers, we found out that based on the AMI, the average median income in that area, we can get $2,830 a month for rent for each housing voucher that we put in there. We're not filling hundreds of them. So where these little tiny apartment complexes come into play with their massive winners is in little scenarios like this, because it's not as hard for the city to give you 10 housing vouchers as it is for them to give you 150 housing vouchers. So we've never done multifamily in the low income or Section 8 before. This is our first time. So with a little bit of due diligence and a little bit of our existing knowledge from studying the market and prior circumstances, we go in and we're going to add the low income housing vouchers to this and get $2,800 a month. Now, with that said, based on a 95% occupancy, we will make approximately $1.6 million in less than 9 months on this small little build. Now, not only are we going in and taking advantage of government-backed housing vouchers that help stabilize the affordability component for tenants, but we're also able to go out and make a profit doing it. And so one of the big things, ladies and gentlemen, is always position yourself to win. Ladies and gentlemen, the time is now. Take advantage of going in and making sure that you're doing things correctly to profit from the upside of multifamily and housing vouchers. Well, the one thing that I told you guys that you never, ever do, and this is the key component, is never let the city, with those affordability components, ever put rent restrictions or rent caps on your units. That is the only must not do for yourself to be able to continue growing in that asset and making sure the profits are real. Ladies and gentlemen, for more content just like this, click and subscribe. I look forward to seeing you next time.